Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bhambwani. I'm a trader since 1986 and I want to help my viewers, my friends, help take better decisions in the markets, and I want to help you use my experience to shorten your learning curve. There's an old saying in Wall Street: those who do not learn lessons from history are often condemned to repeat them. July 2022 is a special landmark area in the history of global financial markets because it marks the 25th anniversary of the dreaded Asian currency crisis of 1997. What lessons are to be learned from this history? What you can do to protect and insulate your portfolio of investments and or trades, and how should you walk about in a market that could turn challenging itself. Remember, in 1997, the one word that comes to my mind was a landmine. Markets were a landmine. You had to walk through this landmine without blowing yourself up. What was happening then? What is happening now? And are there any parallels? So, you see, Asia was being touted and pushed as the future superpower, a manufacturing hub, the factory of the universe, and the next determinant of the global power center. Not without a reason. We have in Asia the largest concentration of human population compared to any other place. We have cheap labor, very conducive weather and climate where we don't get bogged down by snow and excessive heat, etc., etc. So we are the powerhouse of the universe, and yes, we can be the factory to the universe. The Western countries gave us abundant amount of low-cost finance to be able to expand our factories so we could sell our goods and services to the West. Everything was going on fine till July 1997. You see, what was happening was, when you have a lot of low-cost money coming in through an economy, there is bound to be a certain amount of inflation. And when inflation rises, inflation by the Austrian School of Economics believers is also known as the misery index, because it is supposed to make life difficult for people. So inflation started rising, and as usual, when inflation rises, your currency starts to erode its purchasing power parity and start losing weight in comparison to the global basket. Now, the Bank of Thailand basically resorted to a standard operating procedure known to all central bankers. They started increasing interest rates so as to attract foreign inflows. I have in my recent videos explained to you the cash carry trade concept. If America is offering 2% interest and if Thailand is offering 10% interest, the example is hypothetical. Money will flow out of America from 2% yield and flow into Thailand at 10% yield, or so the Thai bankers thought. Now, the cash carry trade would have meant that US dollars would fly in and the Thai baht would appreciate in value and all would be well. Unfortunately, it did not go as per plan. When interest rates went up, corporates in Thailand actually felt the heat, and a lot of industrial activity simply toppled over. How bad was it? I remember one analogy I saw on CNBC Asia. Thailand was the biggest selling point for Mercedes-Benz for luxury sedans. It became the largest market for second-hand Mercedes cars all within 3 months. So people who were buying Mercedes-Benz cars like there was no tomorrow defaulted on their EMIs due to higher interest rates, due to joblessness, due to whatever reason, and they started dumping those cars. The banks repossessed them, started dumping those cars, and Thailand turned into a super heaven for buyers who wanted good quality second-hand Mercedes cars. You saw this same kind of problem brought about by a weakening Korean won in South Korea. You saw the Indonesian rupiah. You saw the Malaysian ringgit simply clamp up, and the Malaysian market came down. FIIs started to pull money out, and in one instance in Malaysia, Dr. Mahathir Mohamad, the then Prime Minister of Malaysia, made a cardinal mistake. He froze FII outflows for 12 months. He said, look, you can sell your shares on the Malaysian Stock Exchange, lock in the price, but let the money lie in your bank account in Malaysia for 12 months. Once you have completed 12 months after your sale date, you can repatriate your money to your parent country. Guess what? Money is like water. And if you remember the story of the Titanic, the engineers who built the Titanic made one cardinal mistake. They assumed that making 12 hermetically sealable steel doors would make the Titanic unsinkable. If there was a leakage in any part of the ship, you close that door, the ship would remain afloat. But the force of water, just like money, is too strong. Money will flow in and flow out where it feels like. You cannot stop it. It's like water. The FIIs panicked and sold all that they had in Malaysia. The market simply crumbled under its own weight. Now, are there any parallels in the world, in Asia today as we speak in 2022? And do we run the risk of the Asian currency crisis repeating itself exactly, or maybe a little more than 25 years after it first hit us? Number one, do remember that no two events are exactly alike. So can exactly the same thing be happening? No, that's not possible, because corporate balance sheets have become bigger. People also tend to learn from past mistakes. Therefore, the next problem that comes is not exactly the same. It will be a little different in nature. So, learning history is of course useful, but you also need to have a little bit of an open mind and say, look, this time around there might be some more variables that will teach us some more lessons. But look at the coincidences. Are emerging markets in Asia, are their currencies weakening against the dollar? Tick mark. So there is one check in a box. Are interest rates across Asia rising? Check. Tick mark. Is inflation rising in Asia like it was in 1997? Tick mark. Is there a spiraling price hike in fossil fuels, which is natural gas, crude oil? Tick mark. So that's inflationary. But the saving grace is, like I told you, we've learned to hedge our currencies. We basically have corporate balance sheets that are a whole lot more stronger. Does it mean that the storm will blow over without impacting us and simply pass us by and say, hey, goodbye, nice knowing you? Unlikely. Why? In a recent video that I recorded over a week ago, I told you how the next flashpoint can come from Europe. Now, here comes the interesting part. So 25 years later, maybe it won't be Asia that might trigger the next crisis or the next decline in the market if it is a mild one. Let's not call it a crisis. Let's not jump the gun. It could be Europe. Why? Look at the way the market capitalization of the German stock exchange as a component of the global market share. Germany is now falling below 1.9% of the global market cap of its stock market. Remember, the German economy is the pillar, the bedrock, and the most strongest economy in Europe. It is now even surrendering its position as a country that has a net positive current account deficit, and that it is doing so after many, many years. Inflation is skyrocketing. They are resisting aggressive interest rate hikes, but like I've explained to you in the video of why Europe might be the next flashpoint in global financial markets, the cash carry trade. The German interest rate remains constant. The American interest rate is higher. By the way, even the British have started raising interest rates. So unless the Germans raise interest rates immediately, money will fly out of Germany and go into England and America. So you will have rising interest rates in Germany. Germany is also the most impacted by the Russians using natural gas and crude oil as geopolitical bargaining chips to the point of weaponizing them, because Germany was receiving the highest amount of energy from the Nord Stream pipeline and the proposed Nord Stream 2 pipeline, which has been a big letdown. So, can the problems that we saw in 1997 reoccur? Yes, they can. Do they necessarily have to come from Asia? Not necessarily. They might come from Europe. Can Europe stave off this crisis at the last minute by some political agreements, bilateral agreements, some kind of peace talks? It's always possible. The lesson here is, what do you do as a trader and as an investor? You cannot be too careful at all. You can't be careful enough. I still don't see the kind of caution or the kind of reaction to this alarming news of rising inflation, rising energy prices, the fall in market capitalization in the strongest economies in Europe, in Latin America, in America itself, the strong companies, the big 20 companies. I don't see any kind of caution. There's an attitude of, look, over a long period, equities are the best hedge against inflation, and maybe in the next couple of months, this too shall pass. Maybe it will, but you need to be more careful about blind purchases in anything that you have purchased in the past and you're averaging now. You can average if you're a very long-term investor. In my video titled Defer Your Long Trades for Now, I told you very clearly that you can average your positions provided you're a long-term investor who has a multi-year time frame, a decade or longer. If you have that kind of a time frame in mind, these issues will look like a small blip on the radar for you. But if you're somebody like me who lives and dies in the market every 59 minutes and 59 seconds, because that is exactly how long I keep a trade open as a micro trend intraday trader, this is not a time to get adventurous or aggressive on the long side. So there you have it. You can seek opportunities where the market is giving you some, but don't go all in and, as they say, bet the bank or bet the farm on fresh long purchases, especially in the leverage space in your short-term trades. As long as you're careful about this and as long as you survive this turbulent period, in the long run, we are all going to be fine. On this optimistic note, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, I love to hear your feedback in the comments section. Also, help me reach out to fellow like-minded smart traders and investors like yourself by referring my video to your family and friends. I thank you for your patience and sticking around with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable day ahead. Bye-bye.